If the prospect of investing in the stock market makes you nervous, you're not alone. Individuals with little financial experience are either terrified by horror stories about average investors losing 50% of their portfolio value or duped by hot tips that promise huge rewards but rarely deliver. It's no surprise then that the investment sentiment pendulum is said to swing between fear and greed. The truth is that investing in the stock market is risky, but when done correctly, it is one of the most efficient ways to increase one's net worth. While the average person keeps the majority of their net worth in their home, the wealthy and extremely wealthy typically invest the majority of their wealth in stocks. The stock market has been volatile recently, with the S&P 500 down nearly 9% since mid-August. While some investors believe a crash is imminent, it is impossible to predict where the market will go. Even experienced investors can be intimidated by the uncertainty, and it's natural to wonder how safe the stock market really is. After all, if your life savings are invested, you'll want to make sure you're protecting your money as much as possible. When stock market prices are falling and experts are predicting a crash, the market can appear to be dangerous. However, in the long run, it is one of the safest places to keep your money. In the short term, the stock market will always be volatile. That is typical. However, despite numerous downturns, it has consistently earned positive average returns over the long run. The market has seen the dot-com bubble burst, the Great Recession, the COVID-19 crash in March 2020, and dozens of smaller corrections and slumps in between over the last 2 decades. Despite this, the S&P 500 has returned more than 167% during that time period. The stock market can be unpredictable over weeks or months, but over years and decades, it's incredibly consistent. No matter what happens in the near future, it's almost guaranteed the market will see positive average returns over the long term. While it may seem counterintuitive, investing even when stock prices are falling may increase your long-term earnings. There are several reasons for this. For one thing, when the market is down, stock prices fall significantly. This means you can stock up on high-quality investments while saving hundreds or even thousands of dollars. Furthermore, when you invest during the market's low points, you set yourself up for substantial returns when it eventually recovers. During the Great Recession, for example, the market hit rock bottom in March 2009. However, the S&P 500 returned nearly 70% that following year. Within 2 years, it had increased by more than 95%. Investing during the lowest lows is the best way to earn those kinds of returns. It is natural to be concerned about investing during a market downturn. Furthermore, there is always the possibility that your portfolio will lose value in the short term as stock prices continue to fall. Maintaining a long-term perspective, on the other hand, will make investing far easier and can also help you maximize your earnings. If you have the means, investing in the stock market right now is one of the most profitable moves you can make. This brings up an important question. Is it safe to invest in the stock market right now? The simple answer to that question is no. Of course, investing in the stock market is never risk-free. In the market, your money is always at risk. As a result, a better question to ask is whether the market's decline has created opportunities where the potential rewards outweigh the risks. Through that lens, there may be a path to where it makes sense to reconsider investing. When interest rates rise, some of the industries that suffer the most are those that rely heavily on customers who must borrow money to make purchases. For example, the S&P Home Builders Index is down far more than the market as investors fear that rising interest rates in a tougher economy will discourage people from purchasing new homes. While rising interest rates make it more difficult for people to buy homes, permits to build new homes remain slightly stronger than they were this time last year. While home building and home buying are slowing, we are also coming off an incredible housing boom in which demand far outpaced supply. People are still buying houses despite the fact that there is a large gap between a tremendous boom and a complete collapse. It's just not as fast as it was at the height of the low interest rate fueled real estate boom. The real question is whether the market's palpable fear of home builders has resulted in at least some of them being available at a discount. In a related vein, rising interest rates mean that companies that lend money have the opportunity to earn more on their lending. For example, despite rising borrowing costs for consumers, banks' interest rates on savings remain stubbornly low. Even so-called high-yielding savings accounts pay barely more than 2%, despite the fact that 30-year mortgage rates have risen to around 5.66%. Banks make money primarily from the difference between the rates they pay depositors and the rates they lend to borrowers. The higher interest rates are, the more potential room there is in that spread, which could eventually translate to higher earnings for them. Of course, there is a risk that if too many people default on their loans, banks will not be able to recover enough from their lending to cover their costs. If the economy remains weak and job losses continue to mount, that risk will be heightened. So while bank stocks are down, at least some of the concern is justified by the possibility of things getting worse.